The webinar will begin in 3 minutes. The webinar will begin in 1 minute. Welcome, everyone. We're pleased that you've joined us for today's webinar titled The Enigmatic Tax Code, Top 10 Things We Cannot Answer. This webinar will last approximately 25 minutes, and at the end, you'll be given an opportunity to receive supporting materials by email free of charge to you. You'll also be told how you may email questions related to today's content to the presenter. Today's presenter will be myself, Linus Sugis. I'm president of Advanced Underwriting Consultants. I've got a background in the private practice of law, as well as a career in the life insurance industry, including years in charge of an advanced sales department. I'm also used to answering tax questions posed by agents, and that's the source of the material that we're going to cover today. Let's go ahead and get started. Although before we do, let's have a poll, and let's let you pick a topic for next month's webinar. The choices are the most asked questions about Medicaid planning, trust as beneficiary of a qualified account, or the 2019 tax and pension numbers. I'm going to go ahead and open the poll now and ask you to vote on next month's topic. So go ahead and cast your vote. We'll give you a minute. Give you about 10 more seconds in case you haven't voted and still want to. So I'm going to go ahead and close the poll, and I'll let you know that next month's webinar will be on the 2019 tax and pension numbers. Thank you for participating in that and for voting. All right, so let's go ahead and talk about some of the things that we can't answer. So as you work with your clients and as other financial professionals work with their clients, tax questions come up, and we here at Advanced Underwriting Consultants are used to answering lots of different questions. We get recurring questions. The most common question we get is, can I deduct the premium for my life insurance policy? If you've called us before, you've had some experience with this, you know that the usual answer is no. But there's some nuance to that answer, but the bottom line answer is no, and the answer is fairly clear. Questions come up, how can I structure my life insurance so that the death benefit will be estate tax free? That's less important now than it has been in the past, but it's still a question we get. We also get questions about tax consequences of policies being max. And most of these questions are easy for us to answer. The details can be complicated, but most of the questions that we get asked have definite answers, but that's not always true. And so a lot of times we have to explain to the caller, and the caller has to explain to the client that the answer is not known. So we put together this list that we'll go through quickly during today's webinar. We'll take about 25 minutes, as I mentioned. That don't have a definite answer. We'll talk about why or how they don't have a definite answer. Sometimes callers, when we tell them that the question doesn't have a definite answer, will ask us, well, can't you do a little more research? And the reason that we know there isn't an answer to the question is because we have done the research. And the IRS has just never given us a final answer. So don't assume that today's list is an exhaustive list, but it does represent some of the most common questions that we get that don't have answers. So the first question has to do with company-owned modified endowment contracts and the potential application of the penalty tax. So if you have a life insurance policy and if the 7-pay rule, the 7-pay limit is exceeded, then the policy becomes a modified endowment contract, and distributions from a modified endowment contract are taxed on a less favorable basis than lifetime distributions from a regular life insurance policy. The distributions are taxed gain first, much like they are for non-qualified annuities, and if the policy owner is younger than age 59 and a half and doesn't qualify for an exception, the extra 10% penalty tax is going to apply. And so that begs the question, if we have a business-owned life insurance policy that is a MEC, or if we have a trust that is a MEC, the question is, does the penalty tax apply? And the companion questions are, does the insured's age, does the insured's disability status, or other potential 72Q exceptions to the penalty tax, are they available when a business owns a MEC life insurance policy? Or are those exceptions never available because a business is the owner rather than the insured? Well, the IRS has never told us. So the answer is, we don't know. And that's the correct answer. We don't know. In our experience, most carriers have opted for the conservative position that the penalty tax will always apply when a MEC is owned by a non-natural owner such as a business. Some may have a more nuanced answer when there's trust ownership, but a lot of them simply take the position that if it's not a natural person, that they are always going to consider that the distributions are subject to the penalty tax, and they will do their 1099 reporting in a way that is consistent with that. So, company-owned non-qualified annuities, let's talk about that. Many of you are probably aware that annuities, non-qualified annuities, grow tax-deferred. There is a special exception to that rule in the tax code under Code Section 72U, which says that if an annuity is owned by a non-natural person, that the growth every year is taxable. And so traditionally, we try to avoid having non-natural entities own annuity contracts, but annuity contracts in recent years have provided higher interest rates than can be obtained with other conservative investments. And so we've seen in recent years more interest in having businesses own annuity contracts. And so the question is, are the earnings that are recognized, the growth that's recognized every year as taxable when an annuity is owned by a non-natural person, are those earnings subject to the extra 10% penalty tax? We know they're subject to income tax, don't know whether they're subject to the penalty tax, and the IRS has never said for sure. If we look to Code Section 72Q, it seems to offer at least a little bit of insight, or at least an argument that the penalty tax does not apply. Let me put it that way. It says if any taxpayer receives any amount under an annuity contract, the penalty tax is applied to the taxable portion. Is the annual growth actually received by the corporation? We can argue that it isn't, but we don't know for sure. If the answer is it is, because the business received an accrual of the interest rate, then the IRS can argue that the penalty tax does apply. We don't know. We just don't know the answer to that question. Let's turn our attention to minimum distributions. We get this question a lot at Advanced Underwriting Consultants. We get somebody who wants to take minimum distributions by annuitizing an IRA account, for example. And they want to annuitize the IRA for a period shorter than life expectancy, and want to argue that the distributions are more than the minimum required for that particular account, and so the extra on the distributions ought to apply toward RMD obligations on other IRAs. And the position makes a certain amount of logical sense. The problem is that we've got this regulation from the IRS that seems to imply that once you've annuitized an IRA, it will satisfy the RMD obligation for the account that has been annuitized, and for that account only. If the annuitization period is for life expectancy or shorter, that seems to be, based on a strict reading of this regulation that we've cited, that seems to be the rule. And so if one takes that interpretation at face value, the immediate annuity distributions cannot count towards satisfying any RMD obligation other than for the IRA account that has been annuitized. Some people think that that makes no sense. And it makes little sense. I'll grant that. That, you know, if somebody annuitizes an IRA for 10 years when life expectancy is 25 years, that some portion ought to be considered an excess distribution, and it ought to go towards satisfying RMDs for other IRAs. Well, the IRS has never said that that's true, and part of the difficulty is we don't know how to calculate the value of an immediate annuity in a way that will satisfy the IRS. We have to calculate the value of an immediate annuity in order to figure out how much of the distribution is an excess over the RMD amount, so that we can calculate how much needs to be or how much can be applied toward the RMD obligation of other IRAs. The IRS has never told us how to do that, and so again, conservative people, conservative companies take the position that the SPIA distribution satisfies the RMD obligation only for the IRA that's been annuitized. Let's talk about another issue. Let's talk about chronic illness accelerations. There are several carriers that have structured chronic illness features that are an acceleration of the death benefit. And Code Section 101G specifically says that if you've got somebody who's chronically ill, who is entitled to an acceleration of a death benefit under a life insurance policy, that those distributions are generally income tax free. So if the insured owns the contract, the insured becomes chronically ill, and the insured claims a chronic illness acceleration benefit, in general, those benefits are tax free. So what's the issue? Well, if we've got a third-party owner of the life insurance policy, such as an irrevocable trust or other third-party owner, family member, or business, the question is, how is the acceleration treated under those circumstances? And the code isn't really clear about most of those circumstances. It is clear that if a business owns the life insurance policy, that an acceleration paid to the business for the insured's inability to do 2 out of 6 ADLs, that the benefit paid to the business is income taxable. That's pretty much explicitly put into Code Section 101G. But if there's a family member or an irrevocable trust that owns the life insurance policy, the question is an acceleration paid under those circumstances tax-free? And the answer is we don't know. Some of the stuff that the IRS has published seems to imply that it might be, but again, it's a stretch to get there. The most compelling argument is that Congress and the President explicitly said that when a business is the owner of the contract, the acceleration is taxable. They were silent on anybody else other than the insured owning the contract, and therefore we should presume that somebody other than the insured's family or irrevocable trust owns the contract, the chronic illness acceleration should be tax-free. But it's an argument, not a certainty, and there we go. We don't know the answer to that one. Let's talk about another situation. Let's talk about IRA rollovers. We get this one a lot. Somebody is trying to avoid the extra 10% tax on IRA distributions, and so they've put together a system of substantially equal distributions based on life expectancy. That's a specific exception to the extra 10% penalty tax on IRA distributions. And then, sure as shooting, somebody's in the middle of their 72T distributions and they want to do a complete rollover of the IRA account to a new custodian. And the question is, does that screw up the 72T distribution scheme? And the answer is, we don't know. Revenue Ruling 2002-62 says that if you're doing 72T and you transfer a portion of the account balance to another retirement plan, you screwed up 72T. Well, here's the question. The question is, if you transfer the whole account, does that meet the definition of transferring a portion of the account? I think we can make an argument that If they meant a portion or all of the account, they would have said so. But all of the account is certainly also a portion of the account. It's the whole portion, but it's a portion. And so we're not quite sure how to parse those words in Revenue Ruling 2002-62. And so the most conservative answer to can we do a rollover during a 72T distribution plan, the conservative answer is no, we can't. We can't be sure that it's going to be safe. Feels like it ought to be safe. Feels like the language implies that it could be safe, but we don't know that it's going to be safe. So that's the longer I don't know. So let's shift back to life insurance. We don't get asked questions a lot about grandfathered split dollar cases. We do talk about people about how to undo old split dollar plans. That is a recurring question. But one of the questions that comes up is on equity split dollar plans. We used to put together split dollar plans where cash value growth ended up on the side of the ledger of the insured. And based on our understanding of the rules before 2003, that equity growth seems to have been income tax free. The insured didn't have to pay any extra in taxes for getting equity growth on the insured side of the ledger. And those plans that were in place prior to September of 2003 were grandfathered. And that's a potential big advantage for plans that are older, split dollar plans that are older than 15 years. And the question is, will a 1035 exchange of the existing life insurance policy be considered to be a material change of the split dollar plan? If the split dollar plan was materially changed or has been materially changed, it's subject to the new rules, meaning that the growth on the employee side of the ledger is taxable, and possibly any growth that happens since the split dollar plan's inception is potentially taxable. So it's an important question. The IRS has never said for sure. We don't know whether a 1035 exchange is a material modification. And so the answer, like the other questions that we've been studying today, is that we don't know. This is a question about 1035 exchanges also that gets asked quite often. It's a question in relationship to taxable boot. The question often comes up in conjunction with 1035 exchanges that have loan balances against them. But let's take a little bit different example. Let's say that I've got a life insurance policy that's got gain in it. Let's say that it's got $5,000 worth of gain in it, and I want to do a 1035 exchange to a new policy. But I also want to get some cash back. The new policy is a very good policy. It doesn't need all of the cash value from my existing policy. So I want to take a distribution of, say, $8,000 before I do the 1035 exchange. Normally, on a non-MEC policy, the distribution of cash value would be a return of basis, and that would be income tax free. But if I do it as part of the 1035 exchange, if I keep back $8,000 as part of the 1035 exchange, the IRS says that is taxable boot, and it's taxed differently. It's taxed on a gain first basis. So I'll recognize on the $8,000 that I keep from the 1035 exchange, I'll recognize $5,000 worth of gain in my example, all $5,000 worth of gain. And so creative people have thought about that and said, well, why don't we take a distribution from the life insurance policy as a partial withdrawal on Monday, and then do the 1035 exchange on Friday. We'll do two separate transactions. The partial withdrawal should be tax-free, return of basis, and then the 1035 exchange won't have any taxable boot, and therefore will be income tax free and will get a better result. Well, the problem is that the IRS has said in a private letter ruling that it has the right to mash steps together if they're part of the same scheme. And so in the kind of example that I said, where the withdrawal happens on Monday and the 1035 exchange happens on Friday, it seems like the IRS is going to mash those steps together and is going to tax the distribution on a gain first basis. And so inevitably, when Jennifer or I describe this problem to a caller, the caller asks, well, how far apart do the transactions need to be so I can avoid the problem? Well, the answer is we don't know. They haven't told us. They haven't given us firm guidelines. Some carriers have imposed an arbitrary 6-month prior to 1035 exchange analysis to decide whether distributions prior to a 1035 exchange ought to be taxed gain first rather than as a return of basis first. They've taken that position for 1099-R reporting purposes. But no one knows the answer to this question. And so if someone's in a hurry to take a distribution and do a 1035 exchange, it could be a real barrier to them running down that path. So we don't know the answer to this question. So modern non-qualified annuities, a lot of them have this enhanced income rider. If you take distributions in a certain way, you're actually going to get more than the cash value out of the contract. And the question is, how are those distributions going to be taxed? And we've got a guess on this. The IRS hasn't said for sure, but our guess seems to be pretty good. The guess is this, that distributions from the gain portion are taxed first. Those distributions are considered to come out first, and they're subject to income tax. How do you measure gain? Well, you compare the gross cash value, not the income value, but the gross cash value to basis to come up with the gain. And so that gets drained out first. After all the gain is drained out, you drain out the basis. And then once the basis is reduced to zero, and if the cash value is also zero, we think that any distributions after that are going to be taxable again. If the enhanced income rider still produces income even after the cash value is zero, then those distributions, once basis is also zero, are going to be taxable again. But the IRS hasn't said so for sure. That's just the way that we think it's going to happen. So we don't know the answer for sure. Same question with regard to income rider IRA annuity contracts. In the past, we were sure that IRAs for RMD purposes would use the account balance. Carriers now understand that that their income riders also have some value in excess of the cash value, and they are starting to use that enhanced value in their RMD calculation for taxpayers. Predicting how much the income rider value is an impossible task for us mere mortals. It requires an actuary to do it, but it's something that's in the regulations. We don't know exactly how those things are calculated, and so it's up to the carriers to give us their best guess about that in coming up with IRA values. Valuing a life insurance policy where the insured's health is less than perfect. We don't have great rules from the IRS about that. We've got rules, but they don't provide a lot of help in those circumstances. Normally, where the insured is healthy, we value a policy based on its interpolated terminal reserve. Where the insured is less than healthy, the IRS has said it's the fair market value of the policy. Well, how much is that? We don't know. So let me wrap this up by saying that the list of things that we must know about in order to provide good help to our clients is pretty long. List of tax issues, for which there is no final answer. Well, we've identified 10 things today. It's also pretty long. So if you're going to do a good job for your client, you got to be comfortable working with not only your clients, but your client's CPA, maybe the client's attorney as well, to provide some tax information. And in ambiguous situations, you got to work together as a team to come up with the best advice for your clients. You want everybody around the table, advisor, CPA, attorney, all nodding yes on behalf of the client in order to provide a client good advice in those situations where the client might be taking a risk with regard to unknown tax positions. So I'd like to thank all of you for joining us today. As a reminder, if you'd like to receive supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com, asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Feel welcome to join us for the next webinar on the first Wednesday of next month, January 2nd, 2019. At this same time, next month's webinar will be titled 2018 Pension and Tax Numbers. Thank you for voting on that. You can also find an archive of our past webinars on our YouTube channel. Please consider subscribing to our channel. It does help us out. Today's presentation will be posted on our YouTube channel by the beginning of next week. And finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again, and best wishes for continued success.